Thank you. Thank you. The most important person in this presentation is the person with the controls. And I hand this over to you to present the controls.
That means I can cut you off when I want to.
You've talked to my wife. Absolutely, absolutely. And I just want to let you know, if this doesn't work well, I have a car running downstairs so I can leave town quickly. It's really an honor to be here. When the search firm came, and this is a good example of a search gone bad, Pat. When the search firm approached us, they told us a number of things, but one of the things that really struck us was, the discipline of knowing when to sell in 2007. And also the ability to push money back from investors. And I told the search firm, this is truly an unnatural act. And out of morbid curiosity, we wanted to come down to Dallas and see what was really going on. And we were totally impressed. And Matt and I have been, and our team have been part of Encore for the last 3 months. And I told Doc this, I just feel it's really a privilege to be here. I've never seen a group that is so well managed and so dynamic and creative, and it's our goal not to diminish the value of this company, but we're very happy to be here, and I'm really excited to meet many of you, and I look forward to seeing you in the future. I'm going to talk a little bit about risk, and investing is about risk and about managing risk, identifying risk, and pricing risk. And so I'm going to talk about some ideas, 8 ideas that I think are kind of interesting. And so with that, I'd like to give you kind of an overview. First of all, I want to ask the question, what is real estate? Now, if I ask most of you, maybe this isn't the case, but if I ask most people what is real estate, they would talk about office buildings, they would talk about bricks and mortar and land and things like that. We have a different view. We look at real estate not so much as a bunch of bricks, but as a basket of financial attributes. And we'll talk a bit about that. Then what we're going to do is talk a little bit about the many faces of real estate. And I know a lot of financial planners think that real estate is REITs, real estate investment trusts. We're going to talk a little bit about the differences between investing directly in property and investing into an operating company through a REIT structure. We're not going to go into depth, but I'm going to give you a sense of the trade-offs and the differences, and that's where we're going to talk about quadrants. The next thing we're going to do is we're going to talk about what is real estate risk and how we should measure it. And people in real estate investing, my observation is that they look at risk and talk about it somewhat anecdotally. I think one of the things that impressed me about Encore is that they're much more rigorous in how they look at risk. Then the question is, once we've identified risk, how do we manage it? How do we mitigate risk? Which risks do we bear, and which ones do we try to transfer to the capital markets? And then there are kind of 2 approaches to investing. And this is particularly true if you have a fund. Now, Encore does not have a fund, but the principles, I think, are very germane to what we do here. The first is the strategic approach. How do you set portfolio targets? And how do you manage those targets long term? And the other is the tactical approach. Timing the market is a good example. And we'll come back to that and we'll talk a little bit about what's happened in the market. And then finally, I want to end on two issues. One is, I want to draw some lessons from the crash. What were they thinking? And I want to show you some examples of decisions that were made, particularly up to the point of the crash. What people were saying, and I want to show you some performance graphs and some other things that I think you're going to find absolutely amazing. And then finally, I want to share with you just a snippet of the office property outlook for Dallas in relationship to the U.S. Next. Okay, what is real estate? I was trained in finance, but also in real estate. But the way I like to look at real estate is that real estate is a hybrid asset. Think for a second about a piece of developable land, maybe a parking lot in New York City or Dallas, or think about a multi-leased property with vacant space. What you have there is a hybrid asset that has bond-like characteristics of the leases, which are a substitute for bonds, and equity-like characteristics. And also a bundle of options. And a good example of that is the option to lease the option to delay, the option to change the use. And so what we have here is a complex portfolio of bond and equity-like instruments in addition with options. Now, the way investors typically look at real estate, they'll think about, well, we have so much in office, we have so much in apartments, and our portfolio is diversified. Sometimes people labor under the assumption that they're diversified when in fact, much like being on the Titanic, just because you're in steerage and the other person is in first class doesn't mean you're diversified, particularly if there's a serious problem. For example, in San Jose, there are certain drivers, technical drivers that are particular to San Jose. And so the question is office and retail, are these complements, are they substitutes? And even if they're highly correlated, if I'm building a portfolio and I look at office and I think office is priced too richly, maybe I can get the same kind of exposure through retail or through multifamily. So by thinking about risk elements, you have deeper insights into doing deals, into building portfolios. And even though, again, we don't have a fund, I think some of these ideas could be very relevant when you think about your portfolio. Next. Okay, let's talk about real estate equity and debt, public and private. And this is an exhibit that I find extremely useful. One of the points I want to make is that anything you can do with non-real estate assets, corporate bonds, traded corporate equity, whatever, you can do with real estate. And what the great revolution in real estate over the last 20 years is the realization that real estate is another component of the capital markets. Now, when we look at this exhibit, what we see is in the debt markets, you have public and private, and in the public debt markets, you have something called commercial mortgage-backed securities. And I spent some time at Nomura engineering these instruments. And the way these are structured is you take the income coming off of a property and you structure it into different classes of bonds that have different priorities. And you've heard of terms like toxic waste, weapons of mass destruction. That's what we worked on. And what's interesting about this is that you create substitutes for high-grade corporate bonds, and you create these subordinate tranches, and these subordinate tranches have a very high correlation to what we would consider to be the risk factors associated with real estate. Now, coming down to private, you can invest in mortgages and other kinds of fixed income instruments. Mezzanine, there are funds out there that provide mezzanine debt, acquisition lines, et cetera. So there's different ways of investing in debt through the private markets. Now, up here we have REITs and real estate operating companies called REOCs. And a REIT can either trade in the public or the private markets. Well, in the private markets, it doesn't trade. But for purposes of this discussion, we're talking about publicly traded real estate investment trusts. And when you invest in a REIT, you're not investing directly in a property. You're investing in an operating company, right? And the operating company can go out to the market, it can raise unsecured debt, it can do a variety of things. Because of the REIT rules, the REITs tend not to do development because they can't trade. They're anti-trading rules. But what they can do is do JVs. And a lot of these REITs did do JVs. And then coming down to here, the private and equity side, we have something called property. And that includes a number of strategies, core plus, value-added, opportunistic, and development. What we do is we do value-added and opportunistic and development. And I'm going to come back a little later and make a very important point. And that is in each of the property teams we have here, we have large experienced teams in each of the areas. What we're able to do in each of the areas, whether it's retail or office, we're able to toggle back and forth between development, opportunistic, and value-added, depending on where relative value is. And we'll get to that in a second. Next. Okay, let's talk now about real estate risk, how we should measure it. The way I look at risk is I look at risk that we can shed into the capital markets, and I look at risk that you cannot shed. Systematic risk are shocks due to changes in interest rates, changes in expected GDP growth, changes in expected credit spreads. Notice I keep using the word expected, okay? And a lot of these risks are, particularly if you're a domestic investor, are very difficult to shed. But there are other kinds of risks that are easier to shed. For example, if you've invested in a portfolio of common stock, the risk that the CEO of Walmart has a heart attack is something you can diversify away, okay? The risk that if you have a large portfolio of real estate assets, that the locality rezones the land. You know, at the deal level, that's a hardship, but at the portfolio level, those kinds of risks can get diversified away. And a tenant default is another good example, are changes in rental growth. So there are two kinds of risk, and risk is unanticipated change. This we can't shed, this is what we have to assume, and this is what we can shed through diversification. Okay, at the deal level, the kinds of risk, there's many kinds of risk. And you hire an investment manager to be able to identify, price, and manage these risks. Some examples, quick examples. At the deal level, property market and submarket risk, tenant credit quality. You know, when we look at corporate bonds, we think of the credit spread. Well, there's actually a credit spread for tenant leases, although it is not, it's not something you can find on the internet. Just because it doesn't, you know, it's not on the internet doesn't mean it doesn't exist. Tenant diversification and default management. This is something interesting, I think, because a lot of people think that they're diversified and they have apparent diversification but not true diversification. They have naive diversification but not true diversification. And a good example is an office building in Houston that has a law firm, an energy firm, a private equity firm. You know, they're all highly correlated. Then the question is, how do you achieve true tenant diversification? It's challenging, and so you have to be able to underwrite tenant credit. So a good investor knows how to do that. Buying below replacement cost. Buying below replacement cost is like altitude to the pilot, and it provides more margin for error. A good issue, though, is what is replacement cost? A firm that used to be very big in real estate was the Equitable, and they built a very, very large, top-of-the-line, AAA hotel in a desert, and it was absolutely the most beautiful hotel that was imaginable. It was the most beautiful hotel imaginable. Thank you very much. But what happened is that hotel, they overbuilt it. And so talking to an investor, they said, well, we can buy that hotel below replacement cost. Well, you know, you can imagine, you know, buying a hotel, you know, in Death Valley, you buy it below replacement cost. You know, is replacement cost zero or is it some other number? So you have to really think through that very carefully. And then barriers to entry. We always look for supply side constraints. Phoenix, there are fewer barriers to entry than New York. But still, you know, people will say, well, you know, there's no more vacant lots in New York. And there's, you know, that's the ultimate barrier to entry. But I always ask people, when was the last time we built a building in New York on a grassy knoll? So you can tear down buildings. So these barriers to entry are not absolute. And then clearly the property life cycle. At what point, where is the relative value? Is it buying the land and entitling it? Is it buying entitled land and developing? Is it taking a package that's already been entitled and doing something else with it? And so part of the investing game is to figure out what works. Next.